Hi, welcome back to another edition of Lippers Fund Flows Insight. My name is Tom Roseen. Thanks for joining me today. I'll be reporting flows for the weekend of Wednesday, September 13th, 2017. Investors injected for a second consecutive week money into the conventional fund business to the tune of about $12.5 billion. And this was actually during a very conservative week. Investors were actually in a flight to safety, take the risk off mode, and basically it was, as we've all heard about it, just the threat of Hurricane Irma coming on shore. We heard about the Caribbean kind of getting wiped out, and on Thursday and Friday, the beginning part of the week, basically we hadn't heard what was going on, but certainly the storm was upgraded to a Category 5 hurricane, and I think investors really were thinking the worst. In fact, insurers got crushed during that week. We saw the 10-year Treasury drop down to 2.06. Truly a flight for safety was occurring. However, later in the week, after Hurricane Irma actually hit Florida, and devastating as it was, just crushing the Keys, Florida Keys, and then also southern Florida, it really turned out to be not as bad on a broader scale for Florida as originally thought. Things kind of tamed down a bit, and it wasn't as devastating as you got inland and to northern Florida and the like, and into Georgia and the like as well. So investors also had some pretty encouraging news when they heard basically that July unemployment, or actually employment openings, had reached an all-time high at 16.17 million for July, and actually it's the second consecutive month that we've been above 6.1 million openings, and that's the first time since 2000 that we've seen that. So it's been a long time since we've seen 2 consecutive months with openings, about 6.1, 6.2 million job openings. Certainly that boded well for people saying, hey, the economy is improving. Also, we heard good news from the Census Bureau. Census Bureau came out and said basically that in 2016 incomes were up, and it kind of went hand in hand. Before the Great Recession came on, basically it looks like we've caught back up with income. I would expect that we keep on going, but again, another sign that things were improving, and that boded well for performance. We actually had pretty strong performance for the week. Well, let's see how all those news items actually panned out into flows into the mutual fund business. We'll be talking about conventional funds first. Let's turn to our macro groups to get a closer look on that. Macro groups, we take a look at equity funds actually lost about $4.6 billion. There's that risk off that I was talking about. Taxable bond funds, so about $927 million in outflows. But muni bond funds took in $331 million, and money market funds, the only reason we're in positive territory, again for the second consecutive week, we saw $17.7 million of net new money come into money market funds as people were taking money, putting it on the side, and really waiting to see what the storms were doing, and also what North Korea was going to do. Everybody thought that they possibly were going to launch a missile again over the weekend, which they didn't, and again that was a boon for the market as well. Well, let's see how this actually panned out into the individual macro groups. Let's first focus on equity funds. Equity funds actually had a pretty solid return, 1.47% return, third consecutive week that they were up, but it is the 25th consecutive week that they've actually handed back money. Conventional equity funds handed back about $4.6 billion in total, and how it broke out, domestic equity funds saw about $2.9 billion, 37th consecutive week they've seen outflows. And then if we take a look at non-domestic equity funds, they basically at a 1.50% return. Non-domestic equity funds also lost at $1.7 billion. This is the first week in 4 that they have seen outflows. So that's kind of the story. Again, investors, even though the market did pretty good, they were still very hesitant about jumping back in the market. If we take a look at a detailed focus on the macro groups and go to the sub-classifications, we saw large cap funds actually lose about $2.3 billion, and global equity funds, this really was a U.S. risk off, about $1.5 billion in outflows as well. We saw some minor inflows actually for international equity. Let's take a look now at ETFs and see how it panned out. A little bit of a different story there. A third consecutive week that they've seen inflows, this time to the tune of $4.2 billion. At the top of the group, Spider S&P 500 saw about $2.3 billion in inflows. iShares Core MSCI EFA saw about $828 million. And if we look at the very bottom of the barrel, we take a look at it, we see that the Spider Dow Jones Industrial Average had about 277 in outflows, and then when we saw the Industrial Select Sector Spider Fund lose about $587 million. So that was a story on the ETF side. So certainly the risk off was more on the retail side than on the ETF side. Let's take a look now at what happened in the bond fund arena and get a picture of that. For the first week in three, they've actually seen outflows, this time to the tune of about $927 million. Third consecutive week, though, that they've actually seen plus side performance of a 0.10% return. Not a lot to write home about, but again, positive nonetheless. At the top of the group, how this actually panned out, we saw government, treasury, and mortgage funds taking about $143 million. There's that risk on I was talking about, or risk off that I was talking about. And that's for the sixth consecutive week they've seen that net inflows. And we also saw corporate investment grade debt funds taking about $135 million. 15th consecutive week that they've taken inflows. At the bottom of the barrel was balance funds. And balance funds lost about $1.1 billion. We saw a little money go out of flexible portfolio funds and out of treasuries themselves. So maybe not such a risk off type of stance because, again, patted the coffers of mortgages, so treasury mortgages, and also corporate investment grade debt funds. Let's see what happened now with the ETF side of the arena for fixed income funds. Saw about $2.8 billion in inflow. This is the 10th consecutive week they've seen net new money come into their coffers. And how it broke out, we take a look at it. iShares 20-plus treasury bond took in about $1.7 billion. Well, there's that risk-off mentality, and they were certainly, the authorized participants were certainly making the bet that investors were going to zap up them shares, and they certainly did. And then, so they took in about 1.7. Then the iShares 3 to 7 year treasury bond fund took in about $670 million. At the very bottom of the group, we saw the iShares iBox investment grade corporate debt fund actually lose a little bit of money, $652 million in outflows there. Let's take a look now at the muni bond fund arena. And again, as I told you, they had a plus side experience as far as inflows go. $313 million worth of net new money came in there. 9th consecutive week they've taken in money. And it's the first week in 4, however, that they've actually seen negative returns. So it's about 0.14%. Downside performance, not a lot again to talk about, but again, negative nonetheless. But we think this move was really kind of, again, getting away from those risky portfolios, going into more safe haven areas, and certainly munis have played that role over the months and years, the last several years. If we take a look at the bottom of it, the top of it, high yield munis actually took in the most money of that group, $267 million for the 10th consecutive week of taking in net new money. Let's take a look now at money market funds. And money market funds for the second consecutive week actually took in money, $17.7 billion. Again, investors willing to sit on the sideline. How it broke out, taxable money market funds took in about $18.5 billion, while tax-exempt money market funds handed back about $729. But if we take a look at the taxable money market funds, we see the retail investor was the primary, if you will, group that put money back into money market funds, and that was $18.5 billion. $16.8 billion versus on the retail side, we saw about $1.7 billion in net new money coming into that group. Well, that's it for me today, but basically we heard some news overnight at the top of this piece. I was talking about that North Korea did not test any missiles over the weekend. They had their Founders Day or whatever it was called. But anyways, they were supposed to theoretically test missiles over the weekend. They didn't. However, they did last night, early this morning. And they launched a long-range missile basically over Japanese airspace, and it proved again that they are able to reach Guam, and certainly U.S. forces that are stationed on Guam as well. So we'll have to see how that impacted the market and whether it put them in a tizzy again, or if they're basically just thinking of them as flexing those muscles and just saber rattling. But certainly it's a concern. Many people, the whole world's keeping an eye on it, obviously, UN and et cetera. But certainly that was news for us to consider. Well, until next week, actually, if you want to do a deeper dive on the data that I presented this week, but I didn't touch those areas that you were wanted covered, you can always go to our site at www.lipperusfundflows.com, or again, you can meet us next week, where one of our analysts will talk about the flows trends for the week. Until next time, my name's Tom Roseen, wishing you the best in your wealth planning and creation.